What really happens before a market collapse? What triggers a plunge that doesn't just pop a single bubble but drags the entire economy into a crisis that can reshape an entire generation of American investors? We saw it in 2008, when mortgage-backed securities, considered absolutely safe, inflated the biggest housing bubble in modern history. And it burst when default rates skyrocketed, sending home prices in many areas down as much as 40%, wiping out the wealth of millions of families. Or like 1987, when in a single day the market evaporated more than 20%, or further back, the crash that led to the Great Depression, when a quarter of Americans lost their jobs and long breadlines of the homeless became a familiar sight across the country. But the most important thing is this: most collapses never come out of nowhere. The fear of waking up to find your 401k, IRA, or life savings gone is real, but there are always signals that appear before disaster strikes. Markets never crash suddenly. It's just that the majority of investors don't see what's coming. And if you know what to look for, the patterns that always repeat, you can avoid becoming a victim of the next drop. So in this video, I'm going to show you 4 patterns that always appear before a collapse. And more importantly, I'll show you what smart investors can do right now based on the signals the US market data is sending today. To understand the first pattern that always shows up before every market collapse, we have to go back to the Netherlands in 1634, a setting that seems distant, but the human psychology there is so identical to today's Wall Street it will give you chills. It was the golden age when the Dutch had just become Europe's wealthiest trading hub. Merchants were returning from the Indian Ocean, the Far East, and Africa with ship holds full of spices, silk, and exotic goods. Wealth arrived so fast that the middle class suddenly had more money than they ever imagined, and with that new wealth came a new desire to show off status. In that environment, the tulip, an exotic flower with rare colors and strange patterns, suddenly became the ultimate status symbol. The rarer it was, the more expensive, the more it was chased. And that's when FOMO, a modern term but probably as old as trading itself, spread through Amsterdam like a plague. To make it easier to picture, imagine a fictional but historically accurate merchant. Jan van der Veen. Jan wasn't the richest in the merchant community, but he was obsessed with looking as successful as everyone around him. At parties, he heard friends bragging that they'd bought a tulip bulb worth a whole month's wages for a skilled craftsman. Then he heard another merchant flipped a tulip contract and doubled his money in 2 days. Gradually, Jan became convinced that if he didn't join in, he'd be left behind. This is the seed of the psychology that creates every bubble in history. Not greed, but the fear of missing out on what everyone else has. Tulip mania exploded when the market invented something the Dutch had never seen before: futures contracts. Instead of trading actual flowers, people traded the right to receive flowers in the future, and those contracts quickly became worth more than the bulbs themselves. In just a few months, the price of a tulip contract could rise from the equivalent of 1 month's salary to many years of a family's income. The rarest bulbs were priced like a canal house in central Amsterdam. And Jan, like thousands of others, believed he had found the key to permanent wealth. But what was really happening? 4 ancient psychological mechanisms were working at the same time, mechanisms that still drive American markets into frenzies every decade. Greater fool theory. There's always a bigger fool willing to buy your asset at a higher price. Herding behavior. When society all runs in one direction, we believe it must be the right direction. Illusion of control, the delusion that we understand the market and can control risk. And narrative fever, the power of stories that sound better than reality. When the story tulips only go up spread, it became truth in everyone's minds, no matter what the actual data said. Sound familiar? Because we saw it again in the dot-com bubble of 1999, when hordes of American investors believed any company with "com" in its name would make them millionaires. We saw it in the cryptomania of 2021, when Bitcoin, Ethereum, and hundreds of meme coins shot up like rocket fuel. Then GameStop and meme stocks in 2021, when millions of retail investors thought they could beat Wall Street with internet memes. And most recently, the AI's chip mania of 2023-2024, when the entire US market collectively believed every company with AI in its pitch deck would be the next NVIDIA. All these manias started with the exact same pattern #1, overconfidence psychology. Once investors believe this time is different, that prices can only go up, that there will always be someone willing to pay more, the countdown to the crash has begun. Tulip mania ended the day people like Jan realized there was no bigger fool left. Prices collapsed, contracts became worthless, and tens of thousands of families lost everything in weeks. This is repeated in every financial bubble for the past 400 years. If overconfidence psychology is the initial spark, then regulatory failure is the strong wind that turns a small flame into a catastrophe. This was clearest in the panic of 1907, when the U.S. financial system was still primitive and relied on trust companies that weren't supervised as strictly as traditional banks. When a speculative attack on United Copper rattled the market, loss of confidence spread faster than regulators could react. President Theodore Roosevelt, famous for cracking down on big corporations, actually intervened too late. He pushed aggressive antitrust moves and tightened control at the exact moment the system was already fragile, creating a psychological shock that sent many financial institutions into panic. The 1907 crisis was the first reminder that poorly timed policy can sometimes be more dangerous than no policy at all. But that lesson didn't stick for long. Just over 2 decades later, America plunged into the 1929 stock market crash, a drop that started precisely because of government passivity during the laissez-faire era. The 1920s were the roaring 20s, an age of bootleg liquor, jazz, mass consumption, and of course speculation. The government at the time believed the market could self-regulate and that any intervention would only hurt growth. While everyone cheered the prosperity, very few noticed something called leveraged investment trusts growing into a monster. These companies borrowed massive amounts to buy stocks, then used those stocks as collateral to borrow more, creating an infinite leverage spiral. Hard to believe, but many trusts traded at twice the actual value of the portfolios they owned, equivalent to a fund today worth $1 billion being valued at $2 billion just because of a good story. No regulator asked questions, no leverage limits were imposed. When stock prices dipped slightly, leverage immediately backfired, and when the trust started dumping shares to meet margin calls, the market collapsed faster than anything ever seen. 1929 is the classic proof that markets cannot self-regulate, because greed always runs faster than reason, and a hands-off policy will always get swept away. The scary part is that even the 1929 lesson wasn't enough to keep us alert, because in the 21st century, the US market has created new versions of those leveraged trusts, just with different shapes, more sophistication, and often beyond the understanding of lawmakers themselves. Look at crypto in 2021. The crypto market cap hit $3 trillion, yet there was almost no clear regulatory framework. The collapse of FTX, Luna, Celsius didn't happen because crypto is inherently dangerous, but because a multi-trillion-dollar ecosystem operated almost entirely outside oversight, a true regulatory void. And crypto is just one example. SPACs, special purpose acquisition companies, exploded in 2020-21, pulling in celebrities and big funds alike, but most relied on loose oversight that let companies with basically nothing go public in months. Then Robinhood, zero DTE options, and the phenomenon of retail investors treating leverage like a toy, all growing faster than the SEC could adapt. Even the seemingly unrelated field of AI raises huge questions. When AI models start trading, making investment decisions, and managing risk, do regulators understand the engine of the algorithm well enough? Or are we repeating the mistake of 1987, when portfolio insurance was hailed as a savior, but actually became the detonator for Black Monday? History shows one thing crystal clear: financial crises don't happen just because of greed or individual mistakes, but because policy always lags the market. When a market grows too fast, when brand new complex financial products appear, when technology changes investing behavior in months, and regulators can't keep up or react in time, a crash is only a matter of time. If regulatory failure is what makes the system fragile, then dangerous financial innovation is the explosive placed right under the foundation that nobody sees. And there's no clearer example than portfolio insurance in 1987. A safety belt advertised as protecting investors from losses, but that ended up being the direct cause of Black Monday, the worst single-day drop in US market history. The original idea sounded perfectly reasonable. If the market starts falling, computers would automatically sell a little at a time, like gradually applying the brakes to slow a portfolio's decline. But the creators of these models missed one thing. If every investor uses the same safety belt, then when the market starts dropping, every belt tightens at once, and instead of slowing the fall, it turns it into a vertical plunge. That's exactly what happened on October 19th, 1987. As the indexes began to slide, thousands of computers triggered sell orders simultaneously. The selling drove prices down further, and lower prices triggered even more sell orders, creating a self-destructing feedback loop no one could stop. Experts later described the event with a famous image: the tail wagging the elephant, meaning small, automatic, math program trades knocked down a multi-trillion-dollar market. That was the moment the world realized that financial technology, when deployed without fully understanding the consequences, can become a bigger threat than human factors. But 1987 wasn't the last time we saw financial innovation turn into kindling, because in 2008, the US market created a trio of products so complex that even the people selling them didn't fully understand them. MBS, CDO, and CDS. MBS bundled thousands of mortgages, good and bad, into one package. CDOs sliced the risk into tranches, making the most dangerous debt look like AAA safe assets. CDS were basically bets that borrowers wouldn't default. Put together, the three created a money-making machine for banks and a ticking time bomb for the system. When home prices started falling and bad debt blew up, the mathematical models once advertised as foolproof instantly collapsed. And once again, the world paid the price for believing innovation could replace basic understanding of risk. But that lesson apparently still hasn't stuck. Because in today's era, we're witnessing modern versions of those dangerous instruments, just with different names, different tech, and different speed. The clearest example is leveraged ETFs, funds that promise to amplify daily returns 2-3 times. It sounds appealing, but their true nature is a daily reset that causes investors' portfolios to get eroded in strong volatility. Or zero-day options, contracts that expire the same day they're traded. This is a new product that exploded after 2020, generating massive trading volume and turning the market into a high-speed casino. When everyone is betting on hourly swings, even the slightest market wobble can trigger a chain reaction. And finally, a new force is rising fast: AI-driven trading. As AI models start making investment decisions, predicting volatility, and automating entire portfolios, we're stepping into territory where humans no longer fully understand the system's thinking. AI can learn from data, but it can also amplify tiny biases into massive market reactions. And if one day many large funds end up using the same algorithm, even unintentionally, AI could replay the 1987 scenario, only faster, bigger, and harder to control. Looking back at all three periods, 1987, 2008, and right now, we see one undeniable common thread. Every financial product hailed as failure-proof eventually becomes the kindling for the crash. Innovation drives markets, but innovation that isn't fully understood is always the disaster trigger. And if dangerous financial innovation is the match, then debt accumulation is the gasoline drum sitting right next to it, silent, invisible, and always making the final explosion far worse than anything before it. For me, pattern hash 4 isn't just a historical concept or some interest rate chart in a textbook. It's a real memory because my family lived through it. In 2008, the first house my parents ever bought, a modest suburban home with a backyard big enough for 2 kids to run around, suddenly became a burden. My parents had taken out a subprime mortgage, the kind of loan banks were handing out back then to anyone with a pulse. It came with a teaser rate, super low for the first 1 or 2 years. Then it adjusted, usually doubling or tripling, but at signing, nobody cared. Home prices were going insane. Neighbors were flipping houses in weeks and making tens of thousands. The bank said, "Don't worry about the reset, just refinance when the time comes." Real estate only goes up, but the market didn't go up forever. My parents' adjusted rate jumped from 3% to over 8%. The monthly payment skyrocketed. When they tried to refinance, home values had already plunged, and the bank said no. And then, like countless other American families, we had to move out and leave an empty house with a foreclosure sign in the front yard. I was little, but the feeling that life had been turned upside down is something you never forget. Only later did I realize we didn't lose the house just because rates rose. We lost it because an entire financial system had built its foundation on pattern hash 4 systemic debt buildup. Subprime and ARM loans weren't individual mistakes, they were deliberate products. Banks knew many borrowers couldn't afford them long term, but that didn't matter because they didn't keep the risk. Instead, they packaged all the loans, even the worst ones, into MBS, sliced them into tranches inside CDOs, and sold them to investors around the world, a terrifying sleight of hand turning risk into safe assets. The IOUs of millions of ordinary people suddenly became AAA investment products, thanks to credit rating algorithms and rosy assumptions. Risk was passed around not once but dozens of times, like kicking a flaming ball down a long line of flammable material and hoping it never drops. But debt didn't just pile up in housing. It accumulated across 3 layers, creating what experts call systemic debt. Layer 1, household debt. Not just mortgages, student loans, auto loans, credit card debt. In 2024, American credit card debt topped $1.1 trillion and delinquency rates are climbing to the highest levels since 2012. When incomes don't keep up with living costs, people bridge the gap with debt. When the economy slows, this layer cracks first. Layer 2. Corporate debt. US says. Companies borrowed more than ever during the low-rate years of 2010-2021, and now hundreds of billions in corporate debt have to be rolled over at double or triple the original interest rates. Hundreds of zombie companies, firms that only survive by borrowing new money to pay old debt, are staring at bankruptcy. Experts call this the corporate debt rollover crisis, and it's a serious fire waiting for a spark the market is underpricing. Layer 3. US government debt, the biggest and most dangerous layer. National debt has surpassed $34.36 trillion, and interest payments alone could soon exceed the entire defense budget. When a country has to borrow just to pay interest on old borrowing, the model can't last forever. A small shock in the bond market could send the whole system into a panic spiral. The key point is debt is never an immediate problem. Nobody wakes up one morning and says, "Today all our debt became dangerous." Debt is like pressure building inside a giant pressure cooker, silent, unnoticed, and completely harmless until there's not one more inch of space left. When the market finally takes a hit, whether from rising rates, falling home prices, a tech reversal, or shaken confidence, debt is what turns a correction into a catastrophe. 1907, debt. 1929, leverage. 1987, portfolios quietly loaded with leverage. 2008, subprime debt dressed up as safe. And today we're living in an era where all three layers, household, corporate, and government, are rising, stretched, and fragile at the same time. That's why pattern hash 4 isn't noise or some distant warning. It's a serious wake-up call. Debt doesn't cause the crash. It just makes the crash bigger, faster, and more devastating. So how do you know if a collapse is getting close? Because if these 4 patterns always repeat, your job isn't to guess the exact day the crash happens. It's to recognize when the system starts echoing the familiar sounds of history. And you can do that with a very simple but extremely powerful checklist. Question 1. Are there signs of overconfidence? Are investors buying assets because they believe prices can only go up? Is the beautiful story beating the data? Are we seeing irrational rallies, AI frenzies, cryptomanias, meme stock blow-offs? If market-wide FOMO shows up, that's signal number 1. Question 2. Is there a regulation gap? Is a new market exploding, but the legal framework hasn't caught up? Loose crypto rules? AI making investment decisions without oversight, SPACs and zero DTE options growing too fast. Whenever technology outruns the law, systemic risk is smoldering. Question 3. Is there dangerous innovation? Are products being marketed as can't fail everywhere? Leveraged funds, ultra-fast trading algorithms, AI market prediction models, 2x, 3x daily ETFs? If you hear the phrase, "This is the future and it can't lose," that's the most dangerous sign of all. Question 4. Is there debt overload? Household debt rising, credit card delinquency at multi-year highs, companies rolling over debt at double the interest rate, government borrowing ever more just to pay interest. When every debt layer is stretched, the smallest shock can start a domino chain. And when you start seeing yes to all 4 questions, you don't need to predict the exact hour. You just need to prepare. So, how do you prepare? For the average American investor, the best strategy isn't some secret formula. It's the basic principles that have worked for decades. 1. Invest regularly in broad ETFs like VOO, QQQ, SCHD. Don't try to pick this year's winner. Just own the American market, the thing that has survived every single crisis. 2. Keep an emergency fund. 3-6 months of living expenses in cash or money market funds. When a crash hits, liquidity decides whether you're the opportunist or the victim. 3. Stay far away from leverage. Leverage always promises fast riches until the market turns in a single day. 4. Never try to time the market. Nobody can do it. The people who try usually lose far more than the ones who stay patient. 5. Focus on the long-term portfolio. Markets always recover. Crashes are temporary. Real wealth belongs to those who have time and discipline. Finally, remember the most important warning of this entire story. Crashes always happen, but the person who understands the 4 patterns is never surprised. Don't forget to hit subscribe so you don't miss the critical analysis in the next videos. See you in the next one, where every piece of knowledge helps you become a stronger investor.